You saw the title, I'm investigating Injective's hidden potential, and trust me, what I found might upend how you see crypto. Injective is not just another blockchain, it's a purpose-built layer 1 for on-chain finance. Sounds dry? Stick around. Within seconds, you'll see why this quiet project has my full attention. I'll be honest, I went into this thinking, oh, another DeFi chain, so what? I couldn't have been more wrong. Something kept nagging at me. How is this network flying under the radar while solving problems even the big names struggle with? The curiosity got me. And once I started digging, I fell down a rabbit hole of exchanges without order book lag, near zero fees, and a token model unlike anything I've seen. It felt like uncovering a secret blueprint for the future of finance. Now I can't unsee it. Injective isn't the loud type. In fact, the team seems almost allergic to hype. No flashy promises of 100x gains plastered on Twitter. Instead, a quiet mission: build a blockchain that actually meets modern financial market demands. Think fast settlement, predictable execution, ultra-low latency, minimal fees, and cross-chain liquidity. Sounds like a Wall Street trading engine, right? Exactly. They're constructing a decentralized exchange experience that feels professional, not some clunky bolt-on smart contract DEX. From day one, Injective set out to fill a glaring gap. Traditional finance is slow and bogged by middlemen. Early blockchains swung to the opposite extreme: slow finality, unpredictable fees, siloed liquidity. Neither could handle things like real-time order books or complex derivatives. Most DeFi exchanges barely scratched the surface because their base chains weren't built for it. So, where others saw an impossibility, Injective saw an opening. They engineered a chain specifically for advanced trading markets. Picture this: an order book running on-chain with near-instant finality, matching trades without a centralized exchange in the middle. It sounds almost too good, but that's exactly what Injective's architecture delivers: essentially a decentralized matching engine baked into the blockchain. Under a second, and your trade is final, no uncertainty hanging over your head. It's built on the Cosmos SDK with Tendermint BFT consensus, which is known for fast, approximately 1 second deterministic finality. In plain English, transactions confirm almost instantly and won't get reversed or reordered later. For a trader, that reliability is gold. When I realized this chain was purpose-built rather than general purpose, something clicked. Injective doesn't try to do everything, it focuses on doing finance really well. On the base layer, you've got Cosmos Tech for stability, and on the application layer, you have ready-made modules for markets, governance, staking, etc. No wrestling with the network or reinventing the wheel to launch a DApp. The chain is designed for these apps, so they plug in and just work. As a developer or project, you're not starting from scratch. You're standing on the shoulders of a purpose-built infrastructure. My deep dive naturally started under the hood Injective's core architecture. And this is where it got really interesting. Injective's blockchain comes with built-in modules as first-class citizens. Chief among them is the exchange module, which is basically a full-fledged on-chain order book exchange engine. No dApp has to create its own exchange from scratch. The chain itself provides the backbone. What can this exchange module do? A lot, as it turns out. It supports spot trading, perpetual swaps, futures, all on-chain. Traders get features like a maker-taker fee model, with 0% maker fees possible to encourage liquidity. It's even built to allow cross-chain margin, meaning you could, say, trade a Bitcoin perpetual on Injective using actual BTC bridged from Bitcoin or ETH from Ethereum. And the holy grail? Shared liquidity. Different apps or front ends tapping into Injective all draw from the same liquidity pools and order books, instead of splintering the market. That's a big deal. It means whether you use one exchange interface or another, you're not stuck in a walled garden. There's another stroke of genius here. The exchange module is MEV resistant by design. Front-running and sandwich attacks, those ugly games where bots exploit you, are mitigated on Injective's order book through something called frequent batch auctions. Essentially, instead of processing trades one by one in sequence, which lets sneaky actors slip in between, Injective batches transactions in short time intervals and executes them all at once at a uniform clearing price. No priority equals no advantage to being a malicious speed demon. Hearing that, I had to double take, a built-in defense against MEV on a trading-focused chain. Yes, it's real, and it works by leveling the playing field for normal users. But the exchange module is just one piece. Injective's Cosmos-based DNA means it can integrate a whole suite of modules. There's an insurance fund module for derivatives markets to cover losses on bad liquidations. There's a native Oracle module bringing off-chain data, on-chain crucial for pricing, say, those derivatives. There's Peggy, their Ethereum bridge module enabling trustless ERC20 transfers into Injective's ecosystem, more on cross-chain in a moment. They even thought of regulatory use cases, a permissions module for restricted assets or compliance triggers if an institution needs it. And for developers itching to launch their own coins, Token Factory allows permissionless minting of new tokens on Injective without writing any smart contracty. As I scrolled through these modules, I realized any developer building on Injective has an arsenal of plug-and-play components at their disposal. One module deserves a special call-out, the auction module. Why? Because this ties directly into Injective's fascinating tokenomics, which blew my mind, but I'll get to that soon. The auction module manages Injective's burn auctions, a core deflationary mechanism. In simple terms, the protocol periodically collects fees and contributions from across the ecosystem into a basket, and then that basket is auctioned off to bidders who pay in INJ, the native token. The highest bidder wins the basket of assorted tokens, and the INJ they paid gets burned forever. It's a reverse insurance almost. Instead of fees going to miners or just vanishing, they get recycled as rewards to users who bid, while reducing INJ supply. Honestly, it's elegant. Real economic activity. Fees from trading, etc., directly drives a cycle that rewards users and burns the token supply down. And as a last cherry on top of the architecture, Injective is not stuck with just one smart contract environment. It initially launched with Wasm, the WebAssembly smart contract layer for Cosmos, via the WasmX module. That allowed devs to run Rust-based smart contracts and even do fancy things like gasless transactions sponsored by dApps, meaning a project could cover users' fees, enabling zero gas fee user experiences. But now it's gone multi-VM, meaning multiple virtual machines. Specifically, they've added native EVM support and even have Solana's SVM on the roadmap. More on that expansion in a bit, but the key takeaway, Injective isn't locked into one developer ecosystem, it's embracing many, making it a kind of unified hub where Wasm contracts and Ethereum smart contracts live under one roof, sharing the same security and liquidity. Now, if you're thinking, cool, but what about connecting with the rest of crypto? That's where Injective's Cosmos heritage shines. Being built on Cosmos means it speaks IBC into blockchain communication protocol natively. In plain terms, Injective can directly talk to other IBC-enabled chains in the Cosmos ecosystem. No need for trusted bridges or third-party multisigs. IBC is a standard that lets tokens and data flow between chains like Cosmos Hub, Osmosis, Axelar, Terra, and so on. Injective uses this like a pro. Assets from any IBC chain can flow into Injective's exchange seamlessly. I saw examples of people trading Atom, the Cosmos Hub token, or Osmo, Osmosis's token, on Injective's order books as if it was native, because thanks to IBC, it practically is. But Injective doesn't stop at Cosmos. It knows real liquidity also lives on Ethereum and even Solana, so it integrates with them too. Through its Ethereum bridge, Peggy, and other connections, Ethereum ERC20 tokens can be brought in. The same goes for Solana assets, likely via wormhole or a similar mechanism. The result? Users can trade Ethereum tokens, Cosmos assets, and Solana tokens, all on one order book. Think about that. Instead of liquidity being fractured across Uniswap here, Serum there, Osmosis over yonder, Injective aims to consolidate multi-chain liquidity into one functional market. That gave me chills. It's like solving the fragmented exchange problem. Rather than a dozen isolated pools, you get one deep ocean of liquidity. As an investor or trader, that unification is huge. It means better prices and less slippage because all buyers and sellers meet in one place, regardless of what chain their assets came from. And front ends, like exchanges built on Injective, don't have to compete in a zero-sum game. They can share liquidity and differentiate on user experience or features. It flips the script from siloed decks fighting for scraps of volume to a shared liquidity hub, where everyone benefits from collective activity. Honestly, it's a quiet superpower of Injective, one that most casual observers might miss. When I first wrapped my head around this, I had a wow moment. Injective isn't just a chain, it's more like a decentralized exchange network linking many ecosystems. For someone who's hopped between Ethereum's costly trades, Cosmos's separate zones, and Solana's order books, the idea of one chain tying them together with near-instant trades is borderline futuristic. By now, you might be wondering, there are tons of layer 1s with smart contracts, so what truly makes Injective different? Let me sharpen it. Specialization. Most layer 1s, Ethereum, Solana, Avalanche, you name it, are general purpose. They're like smartphones that can run any app but aren't specifically optimized for one thing. Injective is more like a high-performance trading terminal. It doesn't try to be everything for everyone, it tries to be the best for a specific purpose. Finance. Remember those built-in modules? That's the key. Injective isn't just a blank canvas of smart contracts. It comes with financial primitives ready to use. If you launch a dApp on Injective, you can leverage the existing order book module or the derivatives infrastructure instead of coding it all in a smart contract where a bug could wreck you. This gives Injective a massive head start in speed and safety for DeFi projects. Protocols don't have to wrestle with base layer limitations because the base layer was made for them. I found a quote from someone comparing this approach to others. Basically, on Injective, DeFi apps feel native, while on generic chains, they often feel bolted on with compromises. For example, try running a full order book exchange on Ethereum. You can't. It'd be impossibly slow and expensive. On Solana, you can, but you might sacrifice some safety or composability. On Injective, the order book is a first-class citizen of the chain, as straightforward as an ERC20 is on Ethereum. Another distinction, predictable costs and performance. Because Injective uses Tendermint consensus, it has fixed time blocks and doesn't have wild fee auctions for block space like Ethereum's gas market. Traders get finality under a second and fees that are negligible. This is critical. If you're doing any serious trading or running an algorithm, you can't have your transaction stuck for minutes or pay $50 in gas unpredictably. Injective said, nope, not on our watch. Fees stay minimal. Latency stays low. At this point in my investigation, I had to remind myself, no, this isn't an ad. This is actually how they built it. I even went into the Injective Discord and forums to see if users echoed this. The consensus was that Injective feels fast and cheap in practice, which matches the design. It's the difference between a chain where finance apps are an afterthought and one where they're the whole point. Let's step back and look at how Injective got here. Every project has a history and key milestones that define its evolution. Understanding those gave me context on the tech. Injective's story started a while ago. The team was around as early as 2018 in the crypto scene. By late 2020, they were running a public testnet called Solstice, where they launched synthetic asset trading pretty cutting edge for the time. Early 2021 saw Equinox staking, a phased testnet where community members could stake and help harden the network. That all led up to the mainnet launch, which happened in 2021. Backed by heavyweights like Binance, Injective was incubated by Binance Labs, and well-known investors like Pantera and Mark Cuban, there was significant anticipation. Mainnet came out with the core order book exchange live, and over 2022 the ecosystem started taking shape. They even raised $40 million in mid-2022 to fuel growthic.wiki, in the depths of a bear market no less. By early 2023, they announced a $150 million ecosystem fund to attract developers building on Injective. That got my attention. Clearly, they were serious about expanding beyond just their own team's efforts, bringing in external projects. 2023 was a pivotal year. Injective began pushing the boundaries of compatibility. They introduced something called in-EVM and in-SVM, essentially Ethereum virtual machine and Solana VM environments connected to Injective. Initially, these were on testnets or as roll-ups. In-EVM was like a layer 2 roll-up using Injective as base. The idea was to let Ethereum developers deploy Solidity contracts without sacrificing Injective's speed and cross-chain features. Later in 2023, the Injective EVM was in public testnet, and it absolutely blew up. Over 5 billion transactions and 300,000 plus wallets were exercised on that testnet. Essentially, they battle-tested the EVM edition at crazy scale. Finally, in late 2025, very recently, Injective's native EVM went live on mainnet. This is huge. It means the chain now fully supports Ethereum-compatible smart contracts running alongside its Wasm modules, all on the same network. It's not a separate chain or an L2, it's integrated. Users and devs get a unified experience with shared liquidity and assets across both WASM and EVM environments. From a user perspective, you wouldn't even notice what tech underpins a DApp. You just see more dApps, more assets, and still the same fast finality and low fees. To put some numbers on that performance, after the upgrade, Injective runs at approximately 0.64 second block times, and gas fees as low as $0.00008 per transaction. Yes, you heard that right. A few hundred thousandths of a dollar. Essentially free, but not in a sketchy no fees for now way, rather because the chain is that efficient. And all those tokens that move around? Injective introduced a multi-VM token standard, MTS, so that whether a token comes from the Cosmos side or is an ERC20 on the EVM side, it's treated uniformly across the chain. No double versions, no manual bridges between the environments, it's one cohesive system. As a developer, I can imagine the appeal. You can use Hardhat Foundry and other standard Ethereum tools to deploy on Injective's EVM, or you can write Wasm contracts, and either way, your app can tap into the same liquidity modules, like the order book, and the same user base. New dApps launching on Injective get a leg up. From day one, they can access institutional-grade liquidity through the shared order book. No cold start problem of attracting initial users' liquidity. It's as if every app joins an already bustling marketplace rather than opening a lonely shop on a deserted street. This multi-VM expansion is a major milestone in Injective's history. It positions the network not just as a niche DeFi chain, but as a general platform for Web3 finance. They've signaled that even Solana's VM support is on the roadmap now, aiming to truly unite the big three dev communities, Cosmos, Ethereum, Solana, in one place. If they pull that off, it would be unprecedented. A single chain where you could run code from basically any major ecosystem, with no fragmentation in liquidity or user base. All the tech in the world doesn't matter if using it feels painful, so I tested Injective like a normal user. Wallet setup, bridging, and trading were the focus. On wallets, it's flexible. Cosmos users can use Kepler or Leap, and Ethereum users can connect with MetaMask thanks to the EVM support. You don't have to relearn everything just to get started, which lowers friction straight away. Bridging was simpler than I expected. Moving assets in took a few clicks and a couple of minutes with low fees. Cosmos assets are even smoother through IBC. It's not instant, but it's fast enough that it doesn't feel like a chore. Once you're in, the experience improves. Many apps sponsor gas, so trading often feels gas-free. On Helix, the flagship exchange, trades filled quickly, fees were low, and it honestly felt closer to a centralized exchange than a typical DeFi app, just without giving up custody. Beyond trading, there's more going on. You've got AMMS, vaults, lending, NFTs, and staking tools. It's not just an exchange chain anymore, and the ecosystem already supports a wide range of everyday DeFi actions. The big takeaway is this: fees are tiny, confirmations are fast, and the friction drops away once you're inside the ecosystem. It feels like on-chain infrastructure that's actually usable, not something you tolerate just to stay decentralized. Now to one of the most important pieces, INJ itself. If you care about the token, you need to understand that it's not decorative. It's woven into almost everything Injective does. INJ is the staking token. Validators and delegators stake it to secure the network, earn rewards, and participate in governance. That staking isn't just passive yield, it's how decisions get made and how the chain stays honest. It's also the fee token. Every transaction ultimately feeds back into INJ, and a large share of those fees flow into the burn auction system. More activity means more fees, and more fees mean more INJ getting taken out of circulation. Governance is straightforward. Staked INJ equals voting power. Holders can propose and vote on upgrades, parameters, and ecosystem decisions. That puts real control in the hands of people who are economically committed. The standout feature is the burn auctions. Protocol fees are pooled, auctioned, and the INJ used to bid gets burned. Over time, that has turned usage into a direct supply reduction mechanism. With the INJ 2.0 and 3.0 upgrades, burns expanded beyond just exchange activity and pushed the system toward net deflation if usage stays strong. The key idea is simple. INJ's value isn't meant to flow on narratives alone. If Injective is used, INJ benefits. If it isn't, the model doesn't pretend otherwise. That tight link between real activity and token economics is what makes INJ interesting, and also what makes it honest. By this point, I was convinced Injective has real strengths. It's fast, cheap, and built for trading-heavy finance. But nothing is perfect, so here's the clean strength versus risk view. On the strength side, performance is the headline. Finality is quick and fees are tiny, so trading doesn't feel like a tax. The second edge is shared liquidity and interoperability, pulling assets from multiple ecosystems into one market instead of splitting everyone across siloed venues. Third, the built-in modules matter. Teams can ship financial apps faster without rebuilding core exchange plumbing from scratch. Fourth, the token model is tied to usage through burns and staking, so the value story isn't totally detached from what happens on-chain. And finally, the ecosystem is quietly real. Flagship apps, more DApps arriving, and a community that actually uses the chain. Now the risks. First, breadth. It can't just be a great trading chain, it needs more categories of apps that stick around. Second, liquidity is a constant battle. Order books only shine when market makers and volume keep showing up, not just during incentive spikes. Third, bridges and oracles are always a weak point in crypto, and Injective lives in a cross-chain world, so the attack surface is bigger. Fourth, competition is brutal. Other chains will keep pushing faster rails and better UX. And fifth, complexity. The more specialized the base layer and the more VMS and integrations you add, the higher the cost of mistakes and the harder it is to keep everything simple for builders. During my research, I even hopped into a crypto community I frequent, the Cheeky School free educational Discord, and struck up a conversation about Injective. A few self-proclaimed Injective ninjas there shared their experiences. One mentioned how bridging was a bit scary the first time, given the history of bridge hacks elsewhere. But after doing it once, they were impressed by the speed. Another pointed out that while they love the trading experience, they're hoping for more assets and pairs to trade, basically echoing that liquidity depth concern, right? And a developer in the group noted that deploying on Injective's EVM was a breeze compared to some other Alt-L ones, which was encouraging to hear from an actual builder's perspective. These ground-level insights kept my excitement grounded. Yes, people are genuinely using it and see the promise, but they also have a cautious optimism, which I think is healthy. Now, I need to address something critical before we wrap this up, and I'll do it in the clearest terms possible. This might shock you, but I'm not a financial advisor and nothing in this video is financial advice. Cryptocurrencies are highly volatile and you could lose all the money you invest. You should always do your own research and consult a qualified professional. After all, your investments are entirely your responsibility, and you should know that nothing is ever guaranteed when it comes to investing. Neither I, this channel, nor YouTube are liable for any losses. And this video is for entertainment and educational purposes only. All right, with that reality check out of the way, let's consider where Injective could be headed next and what I'm personally watching for. If you've stayed with me this long, you can tell I'm watching Injective closely. The real question is what happens next, and it comes down to 5 simple things. First, the burn, not the marketing, the actual numbers. If usage climbs, burns should follow. If activity fades, the burn story fades with it. Second, liquidity. Order books only feel great when they're deep. I want to see tighter spreads, thicker books, and real consistency across the biggest markets. Third, the apps. It's one thing to have a flagship exchange. It's another thing to see lending, vaults, RWAS, and new dApps that stick around when incentives cool off. Fourth, security. The more people use it, the bigger the target gets. Bridges, oracles, governance changes, all of it needs to keep holding up under pressure. And fifth, competition. Others will copy the playbook if it works. The question is whether Injective keeps executing faster than everyone else. That's the shift for me. I used to think of Injective as that Cosmos trading chain. Now I see it more like specialized market infrastructure that could quietly matter a lot in a multi-chain future. Subscribe or watch the next video.